Greetings and welcome to the Transform Podcast. This is Season 2, Episode 15. Today's guest is Tasha Preisner, Managing Partner at DeMar Consulting Group. Tasha is an IRS enrolled agent, a federally licensed tax professional authorized to represent taxpayers before the Internal Revenue Service, the IRS. She works with individuals, businesses, and nonprofits to help them navigate everything from tax compliance to complex tax resolution matters. Beyond her client work, Tasha is deeply involved in tax advocacy. She serves as a volunteer member of the IRS Taxpayer Advocacy Panel, where she helps identify ways to improve the IRS's service and responsiveness to taxpayers. And she's also a member of the National Small Business Association's Leadership Council, working to advance policies that support entrepreneurs and small businesses. Her combination of hands-on tax expertise, taxpayer advocacy, and small business leadership gives her a unique perspective on today's tax landscape, and I'm looking forward to our conversation. Tasha, welcome to the show.
Thank you for having me. I'm happy to be here.
Yeah, definitely a pleasure. I want to dive right in with kind of a question about tax savings and how people can get to them. Many business owners think that their tax planning starts in the March-April timeframe, but in reality, by then the game is kind of over with. I want to get your take on that and kind of ask you, where do the tax savings, where are they to be had? Is it before the tax season even begins? Is it the year prior? Where does that typically happen for most people, most business owners?
You are absolutely right. And I have that every year with my clients, this conversation. They come in to get their taxes done. If they come in February and March, then we have a few options left for them. We can often do something like a traditional IRA or a SEP IRA, but that's really like a last Hail Mary. A lot of things should have been done in the prior year. If they come in like October, September, because they filed an extension in April, even those options are gone. But really, it should be during the year that is happening. So right now, 2026, you should be planning to do your tax savings for your 2026 tax return. You shouldn't be thinking about your 2026 tax return during the spring of 2027 or, heaven forbid, the fall of 2027. By then, it is what it is, and you're going to pay what you're going to pay. Right now, you have time to have a lot of flexibility, a lot of wiggle room, and when new tax laws come out, you can just really get a jump on getting your finances in order in comparison with it.
Okay. No, that's great advice and insight for our listeners. What do you think the biggest misconception business owners have about tax planning? What are they thinking that you sort of have to disabuse them of when the time comes when you actually engage with them?
Some of the easiest ones is when it comes to car expenses and mileage, is they believe that they can take actual expenses and mileage, and really those are not and that will catch them by surprise. Another thing is really having your deductions organized. That you're going to miss a lot of things if you don't, because there's a lot of stuff that business owners do during the chaos of the year that just falls through the cracks if you don't have them organized. Whenever you come in and just kind of hand bank statements that are just bank statements for the business, you forget about everything that you paid cash for. You forget about everything that came off of your personal credit card. And that can come up to a significant amount of deductions that you just threw away at that point.
Gotcha. So to the latter point that you made there, when you engage with a client like that, are there any systems or protocols that you can help them put in place to capture those things, different ways they can sort of handle those things better, let's say during the next tax year, or just advice you give them on something like that?
A good bookkeeping system is the first priority that I tell them to set up. My company, of course, can often helps people set up good bookkeeping systems, but they can be done on their own. The one that I usually recommend is QuickBooks Solopreneur if you're a small business. It's fairly simple. Most people can start on it themselves. You hook your bank account up to it, and it just downloads the transactions right into the QuickBooks account. You have to babysit it. You have to frequently tell the transactions whether it's business or personal. But it has a GPS built into it, and so when you go driving around for your business stuff, you can just tell it, start driving, end driving. It's going to track your miles for you. You can take pictures of your receipts and upload them right into your digital filing cabinet there, so you don't have to have just a whole bunch of receipts sitting around in paper in your office either, especially if you're the type of person who loses their receipts all the time, like a lot of people do. And so it's a good type of organizational system to try to get into, so that as your business grows, then your habits will just get better and better. Because as you want to flip into maybe an S Corp later on, or even a C Corp, you have to have those good habits in place, because that's when you start getting in trouble for not having the good bookkeeping.
Gotcha. So coming back to tax strategy for a moment, what do you see clients typically call a tax strategy that isn't actually a tax strategy? Is there anything that they're sort of under a misconception about that they are sort of pursuing, and then you're like, wait, that's not going to cut it, or that's not enough?
Almost anything that they see on TikTok. Yes, it's like a lot of times people will show up with something from somebody who's in their 20s, an influencer on TikTok just trying to get a lot of hits, and they'll say, "Can you do this?" And after looking at it, I'll be like, "No, that's illegal." Or that's only legal in a very small percentage of tax returns. You cannot do that on yours. And so that is disappointing to a lot of clients. I would say that a lot of the influencers are just wrong out there. And I've gotten some crazy requests in, people that hand me these handwritten notes and say, I don't have to pay payroll taxes anymore because somebody on TikTok told me to hand you this note. And I was like, nope, doesn't work that way. I'm sorry. You still have to pay payroll taxes, or else you're going to go to jail.
It seems like there's a whole industry waiting to, come up out of like just nullifying all this guidance that's on social media and so forth.
Yes.
So
Yes.
really glad you touched on that earlier. We may even come back to it a few times with some of these other questions I had for you. But, we talk about how a business owner can sort of steer things in the right direction for themselves. What are like some of the most important tax-related decisions that they'll run up against throughout the year? So like you said, when they're in that active year and they're getting ready for the next year, what can they do that can make things better, easier, smoother for that upcoming filing year?
So oftentimes I believe that good business comes down to two things: good data and good relationships. And so when it comes down to tax savings, that's in your good data set. And if you've got good bookkeeping, then along the lines of that QuickBooks Solopreneur, like I was suggesting, or QuickBooks Anything, or Zero's another one. There's FreshBooks. There's a lot of good bookkeeping programs. But if your numbers are good and you're using good numbers on a regular basis that you can really look at insights on, then, which is something that AI as a tool can give you if used properly, is good insights on a faster basis, then you can make faster pivots in your business. So for instance, if you see that your net income is running high all the time and your cash is running on the high side, then you may want to look at reinvesting that into the business so that you're not paying so much in taxes on it, and that you're using it in maybe advertising and funds instead, so that you're boosting your growth instead of paying taxes on it. Or maybe you want to put that to max out your retirement accounts so that you're paying your future self instead of the IRS instead. But you don't really know these things if you're just basing it off of guesses or your gut instinct, which is what I find that a lot of business owners do, is they make financial decisions based off of gut instinct, and your gut is going to lie to you. You are going to overestimate your income, and you're going to underestimate your expenses. And then at the end of the year, you're going to end up with a higher net income than you thought you ended up having, and at sometimes because you were just guessing, or you're going to end up with lower cash flow because you were just guessing, wondering where your money went. Either way, you're going to end up being just wrong because your brain just lied to you. And you're just going to end up wondering why you didn't have the tax savings you wanted, or you're going to end up wondering where your money went, one or the other. So good data.
This is a good segue to the next thing I was going to ask you, like along the lines of which mistakes you often see entrepreneurs making. And it seems like, maybe you even answered some of that already, but entrepreneurs who are used to like trusting their instinct, working off of their own volition, things like that, it seems like a common possibility that they're going to fall into the trap that you just described. A, is that the case? Do you see that often? And then B, besides that, what are some other common mistakes you see entrepreneurs making, sort of in a repeated fashion across clients, across their business, that sort of thing?
So, trusting your instincts in a lot of situations is good because your instincts helped you grow skills and helped you to get where you are. The problem with trusting your instincts with money is that keeping track of that in your head is really a complex mathematical situation, and most of us just are not born and bred to do that. So we don't have a good enough data set to make those decisions. But it's tempting to do it because we just feel like it's faster. We feel like maybe the time that it takes to do the bookkeeping isn't worth our time, or it's not worth our money to hire someone to do it. But that's when we really start missing out on the tax savings. We start missing out on getting good enough data to make good business decisions. So then we start making bad business decisions. But it's an easy trap for all of us to fall into. And not just regular business owners that don't know the math, but even it's tempting for me myself to do it. Even though I know my brain's going to lie to me, it is tempting for me to still try to trust my gut on my money anyways. And so I have to fight that instinct myself. But other traps that are easy to fall into for business owners is trust. They want to micromanage everything because their business is their baby. I mean, they created this, and so they'll often hire really talented people and then still try to do everything themselves. And it's hard to let the people that you hire to do something actually do it. So then you start burning yourself out by doing all the things yourself.
Yeah, that seems like probably a fairly common one just across the board. I mean, like you said, I think a small business owner is going to treat that situation much the way you described. So it seems like that would be something that would be very, very common. Is there anything that you see people make a mistake, but it's not discovered for years? In other words, it's not something that's getting surfaced in a way that's like immediately accessible or able to be fixed, but it sort of pops up down the road. I mean, kind of catches them by surprise. Anything that you see along those lines with your clients?
Those are often in relationship issues. You can see that. So I said that business comes down to thriving in good data and good relationships. So data will make your business crumble if you're not keeping an eye on it, but bad relationships will as well. And it's really hard for people to accept the fact that they aren't fostering good relationships. And so, in the beginning of their business, when they're excited about things, they can often sort of control that business relationship a lot of times with their employees, with their clients, with their vendors. But if they are the problem in the relationship, it doesn't show up for a while until they see high turnover rates. And after a few years of high turnover rates, that's when you can really start pointing out you're the problem. You're the one who's having an issue with forming good bonds with people.
Gotcha. So, along the lines of the TikTok and the social media remarks that we exchanged, let's pivot to entity structure, fact and fiction. So I'd start off with, is the internet's obsession with LLCs and S corps justified? Because if I've seen one a lot, it's that one.
It is that one, isn't it? So I do not recommend that people become S corps right away. The LLC is a natural one. LLCs are easy to get, and it stands for Limited Liability Corporation. And so that's usually, you can get it in a single member, you can get it in a multi-member. If it's a single member, it's going to be a Schedule C on your own tax form, and it's going to be taxed just like if you were not an LLC. If you're a sole proprietorship, they're taxed the exact same way. So the only difference between not being an LLC and an LLC is how much you spend to the state that you're in. So in some states, you spend nothing. And like, for instance, in the state of Texas, if your gross income is less than 2.4 million, you spend nothing to the state of Texas, because that's where you start paying franchise tax if you're an LLC. In the state of California, if you're an LLC, you pay them $800 a year for the honor of being an LLC in their state. And every state has their own thing within the state. But to the IRS, it's the same. It doesn't matter if you're an LLC or not. It's the same taxation as a single member. As a double LLC or multi-member LLC, it becomes different. Now you're a partnership. And so let's say, for example, if you and I decided to start a business and now we're a multi-member LLC, now we have to do a partnership 1065 form, which gives us K1s on both of our tax forms and splits the income and the tax liability between both of our tax forms. And so that's a bit of a difference there. Now at that point, we can choose to have one of us be a general partner and one be a passive partner. A general partner would pay self-employment taxes just like it would if we were a single member LLC with a Schedule C on our tax form. The passive partner could get away with not paying self-employment taxes. Now, a general partner could, if we had losses, could claim all the losses on their tax form in a year, whereas a limited partner could only claim $3,000 in a year. So there's some pros and cons between there. And you just have to decide what you want to do with that. You could have two general partners. You have to have at least one. You can't have two limited partners. So an LLC is a common way to start. You can start with an EIN. It gives you some protection legally, not 100%, but it gives you a little bit. Like if you were to be sued, it gives you some protection in the state that you're in. So that's a good common one to start with. An S Corp I usually don't suggest people roll over to an S Corp until they have enough income to support a payroll for their owner. Because the law with that is that you can't unlock the benefits with an S Corp until you're paying the owner a reasonable salary. And the reasonable salary is what you would pay your twin brother, your twin sister with your exact same skills that can do your exact same job. And so for a lot of people, that's starting at least $90,000. If you're making that consistently in a year, that you could pay yourself that salary, then it's a nice thing to go ahead and flip to an S Corp. You don't have to pay self-employment taxes at that point. You do have to pay yourself payroll. So you're going to be paying Social Security and Medicare through your payroll that way. But you're not getting hit with self-employment taxes, but it's going to be kind of a similar deal. But you can now do the S Corp niceties through at that point. So I recommend usually that you go from being a solopreneur, that sort of regular, just one person with a Social Security number, to an LLC with an EIN. And then once you have income consistently with that you can start paying yourself, that's when you flip into an S Corp at that point.
Got it. And that's an excellent breakdown of how to sort of proceed there. And what would you say, just continuing a little bit with the S Corp theme, what are some of the myths around it? Are there things people are being told about it that are just entirely untrue, besides like, hey, maybe you shouldn't start out that way? Is there anything else that you're seeing or hearing that's like, hey, that's not even applicable, that's not a benefit that it's going to accrue to you?
So one thing is that you can deduct all of your medical expenses from the S Corp. No, you can deduct your qualified medical expenses through your S Corp. And that is the tricky language through the IRS. The IRS uses the word qualified a lot. Qualified means that it's not going to be everything. You have to define what the IRS means when they use the word qualified. Your Botox expenses might be deducted if they are related to migraines.
Interesting.
If they are related to getting rid of your wrinkles, they are not deductible. That is a difference between qualified medical expenses that are deductible with your S Corp and ones that are not. And so that's a bit of a myth there.
So we're definitely clipping that for social media. Thank you, Tom. One more point on S Corps before we kind of move on. Is there anything people should know about, you talked about some of the income requirements, payroll. Are there any other headaches, continuing the migraine theme, any other headaches like, oh, now I have this additional paperwork to do, an additional tax return to file, like things they didn't even expect to encounter. Now all of a sudden they have these other obligations that they have to meet now that they're an S corporation.
Yes, you have to file a separate tax return from your own personal tax return. You have the 1120S that you have to file. You do have payroll, which is quite annoying, unless you go with a payroll service that'll do it for you. If you do your own payroll service, it'll be cheaper, but then you have quarterly tax forms, you've got yearly tax forms, you've got to do the state tax forms, and then if you have employees all over the country, then you have to do state tax forms for each state that they're in. And I've done payroll, so it's very annoying. So you definitely want to most likely go through a payroll company that's going to do all that for you, and that gets expensive. Otherwise, then you also have, if you're going to be an S Corp, then you have state filings. But the tricky thing with the S Corp, and I do hate this so badly, is that you are an S Corp by permission of the IRS. So you send them a 25, first you become a corporation. That's how you become an S Corp, which is a C Corp. And a C Corp is its whole different ballgame. It's not a flow-through entity at all. It pays its own taxes on its own tax form. Then you can also file a 2553 form where you ask for permission to become an S Corp. You can also flip an LLC into an S Corp using the 2553 form. So there's multiple ways to become an S Corp. But if the IRS grants you permission to become an S Corp, they can take that permission away. And they do, without you knowing about it. And so there have been a number of clients that I've had with a number of years that I'll file an S Corp, an S Corp, an S Corp, and all of a sudden I'll go to file the S Corp form and I'll get a rejection saying it's not an S Corp anymore. And I'll call up the IRS, and the IRS people say, we have no idea why the computers decided it's not an S Corp anymore. They said, refile the form. And so I'll refile the form, and when you do, the IRS has to manually reprocess it because it's not an automated form. It might take them a year to do that. And in the process, you either have to just suck it up and be whatever you were before, either an LLC or a C Corp before, or you have to have the penalties and interest of not filing at all while you're waiting for that permission to come back in. And so it's a gamble. And either way, I hate that. It was their problem, it was their fault, and they caused this problem, and now you're just doing the best that you can to try to deal with it, and there's no good way for you as a taxpayer to deal with it. And they don't have any good answer as to why it happened. It just did.
That doesn't sound pleasant.
It's not. Nobody has fun with it. And it happens every year to at least a 5% of my clients, I would say, that this happens to.
And it sounds, Tasha, like you're saying it's not that you're not allowed to be one, but that some sort of glitch occurs where it doesn't recognize you're one. You have to sort of reinstate yourself.
Yes.
Is that accurate? Okay.
That's accurate. Where the computer system just, for some reason, just pulls your S Corp status, and the IRS agent you talk to on the phone agrees, yeah, you probably should have been an S Corp. Just refile the form, like as if it's going to be easy to do, but it's not. And so it just creates a whole year of, or at least 6 months of hassle now at this point.
Wow. Okay, that's super, super helpful advice. I'm filing that away too. Let's shift gears a little bit back to, we talked a little bit about entrepreneurship in terms of tax. And in terms of the traps that an entrepreneur can fall into, like, where do you see, like what do you think causes entrepreneurs to get, like, surprised by tax bills? Like, where they're just sort of, like, taken aback, they didn't see it coming, they didn't expect it. What's happening behind the scenes that were not happening behind the scenes that leads them into that situation? Have you seen a pattern there in the clients you deal with?
Yes, the first year they're in business.
Okay.
So if they've made money the first year they're in business, they're going from being a W-2 worker that's had taxes taken out of their paycheck every single week. They understand that system. They've gotten a refund. Now they've started up. Maybe they became an Uber driver, and or they did some sort of side business they're starting up. They made money, and they got a 1099 with it. They didn't really track their expenses very well, so they don't have very many expenses to put against that income. And now all of a sudden their tax bracket, they might have jumped up a tax bracket, and so their W-2 withholdings weren't enough to cover that tax bracket they might have jumped up. They didn't have taxes taken out of that 1099 income. They didn't pay estimated taxes either because they weren't even thinking about it. So now that they're hit with these taxes, they were just also hit with self-employment taxes from their 1099 income. And that's 15% on top of the tax bracket that they're in now. And they're hit with this huge bill this first year. I'm telling them, you owe $21,000 to the IRS. And they were not prepared for this news. They knew they were going to owe something, but they didn't realize they were going to owe that much money. That is something that they often fall into, and then they end up getting a little bit behind the eight ball. So they're now into like a payment plan with the IRS, and then the next year they can't pay the estimated taxes for the next year. So the next year's tax bill is also unfortunately having to go into an installment agreement. And this installment agreement can get bigger and bigger and bigger as they're kind of behind this eight ball there. And so that's where tax resolution services has to come in. And sometimes they'll get so paralyzed by this whole process that they'll even stop filing tax forms altogether, because it'll just scare them, because every year this number gets larger and they don't know what to do with that. And so they'll just stop filing in hopes that they can just get caught up on the back stuff. And they know that there's going to be a price to pay whenever they want to eventually get caught up. And they'll do that. They get caught up whenever they need a loan and somebody asks for a few years of tax returns and they haven't done that.
So definitely a nightmarish scenario, Tasha. Like, how do you, let's say you have a client who's now mired in that situation. They've come to you, maybe they're a couple years deep into that scenario. How do you handle them at that point? I mean, what do you advise them? How do you kind of help them remedy that situation, or where do you kind of steer them to go next with that?
So the first thing that I do is I come at them with a point of hope and peace that they're not alone, because they're scared at that point. And you don't want to feel like you are alone, and you don't want to feel like you are in trouble. And so I want them to feel like they have someone in their corner fighting for them. I also don't want them to be delusional enough to believe that this process is going to be easy. And so I tell them that the worst thing they can do is like cleaning your closet, where you take everything out of your closet and then it looks worse for a while, and then you kind of sit in the middle of the junk that you just pulled out of your closet and you think, what have I done? And then you just stop cleaning the closet and walk away, and it's worse because now it's just scattered around in the house.
Guilty as charged.
And that's what a lot of people do. They start the process and they think, I want to get this cleaned up, and they pull out all the stuff from the closet, and then it gets overwhelming because it's sitting around on the floor, and then they just stop and walk away. Yeah. And that's the absolute worst thing to do. Once you start the process, you need to see it through all the way to the end. Otherwise, it's going to get worse in the middle. So I try to lay out the plan. For one, you've got me fighting in your corner. You can contact me at any time that you get scared, so don't stop. If you are scared, contact me instead so I can talk you through the fear. And here's where it's going to get worse, and then here's where it's going to start getting better. So you need to understand and accept that it's going to get worse during this time, and just go through it. And then at the end, we're going to get the tax returns done. Your bill's going to get bigger and bigger and bigger as we get the tax returns done. Hopefully we can find deductions so that it doesn't get too much larger, but a lot of time has passed, and that's going to be hard to find all those deductions with all this time that has passed. So most likely the tax bill is going to get larger. But then we're going to start looking at hopefully an offer and compromise or an installment agreement to make it more reasonable at the end and get you into a situation where it's comfortable at the end to deal with the large tax bill. But you've got to be able to have the fortitude to get through seeing that number grow, to get through the resolution part that we create at the end.
Yeah, I really appreciate you going through that like that, Tasha. I mean, it's probably almost assuredly the only time I've ever heard so much empathy around how someone should handle a tax problem like that. I've heard offer and compromise or the installment plan, but the way you sort of framed it as, you're in their corner and they should come to you first rather than, staying scared and avoiding the problem. That sounds like a tremendously helpful way to, help your clients through that. And I hope that they either come to you for that or find somebody equivalent like that to help them. If we talk a little bit now about like root causes of how they could end up there, and we talk about like audits and the IRS kind of shining a spotlight on a business, and I know our audience will be interested in this, like how can I avoid an audit? What should I look out for? Am I going to be subject to one? Let's start with what you would say are some of the typical things that would attract attention from the IRS. They're going to see it in the return, they're going to flag it, they're probably going to zero in on it. Is there anything predictable there? Or is there any kind of pattern to that, or it's totally random?
So there is some predictability and there's a lot of randomness. So it depends on the type of audit that you're referring to, because there are multiple types of audits. There is a random audit, and that is the easiest audit to deal with. That is pretty much where the bots go through the system. They pick a tax return, they pick a line item, they send you out a letter and say, prove this number. That's kind of more like, think of a jury duty notice. It's kind of more like that. That you're not really in trouble unless you can't really prove that number, in which case they're just going to recalculate how much you owe and send you a bill. And they're going to give you a set time. And if you don't respond within that set time, that's when they recalculate it and send you a bill. There's an audit for what they feel like is you haven't filed for a while. That's pretty predictable. If you haven't filed for multiple years and they have tax forms that have been sent in on you, such as W-2s, 1099s, you're going to get in a letter in the mail saying you haven't filed for a few years, you need to file tax returns. And it may even say, come into our office. And you're going to feel like you've been called into the principal's office. And that one makes people panic. And so the best thing you can do is file your tax returns. And actually, you don't often, depending on how many you haven't filed, you may not have to file all of them. So, for instance, I had a case where someone hadn't filed for 8 years. And when I called up the IRS to negotiate on it, they didn't necessarily want all 8 years. They only wanted the last 2 years. And that worked in the taxpayer's benefit, because if I had filed the last 8 years, the taxpayer would have owed about $30,000. But by only filing the 2 years that the IRS asked for, the taxpayer only ended up owing $2,000. And so by just merely asking the question of how many years do you need, it was a huge amount of savings at that point.
Yeah, it's really interesting. To your previous point, Tasha, about the bot selecting a number and then asking you, hey, can you prove this and so forth. Is there any scenario in which that mushrooms into like, oh, you can't prove this number, now prove these numbers? Or is it just like,
it can.
Hey, you couldn't prove this one, we're going to zero it out and reissue you the bill?
It usually doesn't, but it can. So there is one that's considered a fraud audit, and that's if they believe that you have underpaid by more than 25% of your taxes. So if it starts becoming significant, then that's when it can blossom into more. And then if it's even higher, like 50% of your underpayment of taxes, then it can blossom into they want to look at your whole return. And so that's where fraud starts, is usually at 25% underpayment of the taxes owed. So it can, but it often doesn't. It usually just, they recalculate what you owe and send you a bill. For the most part, the IRS is really overworked and understaffed. They are still doing audits, but it's a lot less than what it used to be right now. There's a lot more that's being done digitally than what it used to be, where you just upload paperwork and they either accept the paperwork that you uploaded or they don't, and they recalculate the bill. A lot of them are going to be based off of Schedule C stuff, which is going to be your small business deductions. You're going to want to be consistent from year to year. If you have a lot of large inconsistencies, that can be a red flag. If you have a lot of things that don't look normal for your industry that you're in, that can be a lot of red flags, because they're looking for consistency for your business. They're looking for your consistency within the industry. They're looking for normalcy within what you're doing. They're as far as if you have expenses showing losses, they're going to want to see income against those expenses. So they're wanting to see logic as well. Like, I had a business, so I'm taking expenses. Okay, did you have income against those expenses? Were you actually doing business, or were you just spending money and pretending you had a business?
Gotcha. Okay. So a lot of scary stuff in there, Tasha. Well, if you were talking about like audit fears that are overblown and underestimated, what would you rank as the top one in each of those categories? What are people like really worried about that probably isn't going to happen? And where are they going to get snuck up on by the IRS in the other category?
Track your mileage. That is one that the bots like to ask you about, that the IRS wants to see some sort of trail on, that people have a tendency to estimate. And they don't like to see estimates on it. So I would say that if you're going to take mileage, track it. Don't just say, oh, I think I drove 25,000 miles last year, because that one is going to be hard for you to prove.
Yeah.
I like to say, make sure your numbers are provable if you're going to put them on your paper. But if your numbers are provable, then you are in a safe zone. Even if it's kind of on the fringes of tax law, and if it's something that's a high audit risk, then you're still fine if your numbers are provable.
Okay. Anything that's overblown, like people are worried about it and they're probably never going to have to actually face it.
Things that come on forms. So people have a tendency to get really worried about stuff that comes on like W-2 forms. And that is not something that is a real worry, because you didn't generate those forms. Unless you did generate the forms, then that could be a problem. But as long as you didn't generate those forms and the form was just given to you and you're using numbers that were given to you, then that's not really something that you were responsible for. If that was a problem, then that's the responsibility of the company that gave it to you.
Gotcha.
But it is something that has a tendency to make people quite worried for some reason, and that I have to frequently tell them, no, those numbers are not numbers you came up with, so you don't need to be concerned with. You need to be concerned with the numbers you generated. Those are things you need to be concerned about.
Okay. I think, kind of closing this line of discussion, like from a documentation standpoint, you definitely talk about good books, tracking mileage. I think you mentioned receipts at one point. Is there any other documentation that just sort of as a baseline, everybody should be maintaining and keeping in good order? Or if they've done those two or three things that I mentioned, that's about as much of a baseline as you can have, and then everything else is a special situation.
Keep your prior year tax returns. Lots of people ask for them. Even when you get a new tax preparer, like I have trained my people to ask for the prior year tax return. It's really good to do comparisons between the new tax return and the prior year. And if you're trying to get a loan, a lot of people will ask for 3 years, but it's something that for whatever reason people often don't do. And so I get calls and emails 3 years down the future of people asking for their prior year tax return, even though whenever I email them their code to download their tax return, make sure you download your tax return. They usually don't. It's a really good idea to actually do that.
Hopefully some of your clients who haven't done it are listening to this right now.
Yes. Please download your tax return.
No, that definitely seems like a huge one, just keeping good files on that. I think I heard somewhere, or maybe from him himself, Warren Buffett, he kept like every tax return he filed since he was like, since his first job or something like that. Like he had every single one of them or something. Seems like a little bit of overkill potentially.
It is.
But yeah, I mean,
if you have 7 years, you're good. But
Gotcha.
at least keep, a good 5 years and you're probably safe.
Okay, no, that's excellent advice. If we look ahead for a few minutes, Tasha, like, what do you think is some tax changes that are coming over the next few years, maybe for next year or the year after, short term, that business owners should be aware of? Anything that's going to change for them that they've maybe gotten used to and it's not going to be available anymore, or maybe something good is going to change that'll help them?
Oh, that's always hard. I wish I had a crystal ball when it comes to that sort of stuff. The government is constantly surprising me. So we had the big bill, the OB3 that came out last year, and that changed so many different things. And yet, even with that, they're working on a fourth reconciliation bill to that bill, which is if they're trying to reconcile a prior bill, that's never a good thing. And considering that they're on a fourth reconciliation of that bill, that's even worse. So yeah, if they keep reconciling that bill, there could be a lot more changes.
Well, that's, just in and of itself a great, piece of information. I think just knowing that changes are always a possibility, that people who are in, or who have started their own business, they should be aware that the ground can kind of shift under their feet. I remember...
It's constant. Change is the most constant thing, especially in the tax world. Nothing stays stagnant. Mileage rates change every year. Your tax brackets change every year.
Yeah.
Things that, like, all the different credits just go in and out of style depending on who's in Congress. You had EVs that had credits. You had electrical things in your house that were credits, and different types of electrical things came in and out of credits. And so just kind of keeping an eye on things that are kind of in style, I guess, of what the current credits are, can be good and can be bad. And I say can be bad because I currently have a minivan that I bought because of the tax credits. And I hate my minivan because it's currently trying to implode on me all the time, piece by piece. Both middle seats now have decided to become just floppy because the springs have decided to stop working, and now they're zip tied together. And so, but I got it on a tax credit, and so, you get what you get. So
Yeah, this will definitely be a YouTube short. This last 2 minutes. I think one that comes to mind for me, Tasha, like when I think about how, let's say, good things can possibly go away, was I think the 2017 tax law with the QBI, the qualified business income, was supposed to like sunset in 25. I thought like it was going to disappear, but maybe they extended it or.
So a lot of the
kept it going.
2017 credits actually became permanent. And I believe that I may be wrong about this because, like I say, tax changes happen all the time. But a lot of them became permanent. And I'm thinking the QBI might have been one of those.
Okay.
I know the QBI is still going on right now. But yes, most of the QBI changes did become permanent and never did sunset. That was part of the OB3.
Gotcha. So I guess kind
And some of that was due to the National Small Business Association, actually. They actually pushed for keeping the those were from the TCJA, and they pushed for that to keep permanent.
Okay. Anything entrepreneurs should be doing, like, I mean, we're in July now. I mean, blink twice, it'll be August. What should entrepreneurs be doing, like, right now before they get too close to year end? I mean, anything that's still doable at this stage to help them for next year? You may have even touched on this a little bit at the
Yes.
beginning.
There's actually a lot. I would say, first, if your books aren't in order, get your books in order so that you know where you are. Then, as you get closer to the end of the year, I usually suggest in the fall, you want to get close enough to the end of the year that you can fairly accurately predict what your income is going to be, but enough of a buffer between then and the end of the year that you can still make financial changes to be able to make a tax plan. Either sit down with somebody or figure out how to make a tax plan on your own. But you're going to need accurate numbers for it because when it comes to math, junk in, junk out. So you need accurate numbers, and then you need to really look at your tax planning for 2026 tax return. Maybe you need to spend more money because you have too much cash flow. Maybe you need to look at buying an asset. Like if you're a trucking company, maybe you should buy a truck. There's just a number of things that you might need to do. Maybe you need to put some money into your retirement account. Maybe that's the way you need to go. But either way, if your books aren't in order, get them reconciled, get them up to date, and in the fall, look at some accurate numbers and make a plan and then implement it before December 31st. That might mean giving some money to charity. It might mean a number of things that could be done.
Gotcha. That's great. Let's kind of close with a few rapid fire questions. I'll just sort of lob a few questions at you, and you can just kind of bat them back. What do you think the best habit is for a business owner? I think I know what you might say here based on some of the other responses. But what would be the single best habit they can make sure they instill in themselves?
Good data. Good data for good decisions. And look at it on a frequent basis.
Okay. What about the bookkeeping? What's the biggest mistake you see in people's bookkeeping?
Not investing in someone with enough knowledge to do it correctly.
Okay. One thing every entrepreneur should ask their CPA.
What's advice that you would give me to do better next year?
Okay. And then one piece of tax advice everyone should ignore. Be everything on TikTok?
If your CPA doesn't know this, you should fire them.
Gotcha. Unexpected. I love the answer. No, okay, great. Well, Tasha, this has been outstanding. I think this is going to be super, super helpful to our audience. Is there anything I didn't ask you that you wanted to mention or cover before we conclude?
No, I think this has been very comprehensive, and I've really enjoyed this conversation.
Yeah, definitely me too. So Tasha, where can our audience find you if they want to engage with you or potentially seek your services?
You can find me at LinkedIn, and I post daily tax tips. I post podcasts like this as well. You can also find my website at demarconsultinggroup.com.
Awesome. Well, thank you again for being on with us today, Tasha. We hope to have you back in the future.
Thank you. Have a good day.
Thanks, you too.